So another famous person named Will Rogers once said that if you have a vision without a plan, it's an hallucination. And so what this tool is trying to do is, with your vision, give you a way to get there financially. Now, if you think conceptually of how you influence financial incomes on a farm, can you imagine the knobs on the machine? The machine is one you put money in here and you get money out over here. The knobs, I'll answer the question, are what am I going to grow? What will my inputs be? What yield will I get? Which is a knob you can't turn except by jiggering around your inputs, and then nature will intervene. What price will I get? And contrary to some of the discussion over here, there are ways in the organic industry to influence what price we get. And they're not big, high-flown things. I've got neighbors who sell grain to their neighbors, organically certified grain, and are not totally at the mercy of the market. So there are things you can do with price, but for the most part, you can't. So it's, what do I grow? What inputs do I have? What yield do I expect I can get? How can I influence that? What price will I get? And how much iron will I have to buy to get this all done? Those are the things that influence profitability. So when we built the tool, we built it so that you, not the university, not some brain in a jar someplace, predict those 5 things. And the one thing that we have a hard time predicting and no chance whatsoever of influencing, with one exception, is weather, is Mother Nature. And the one exception, by the way, is irrigation. So that's the 5th and a half thing. Those are the 5 things that are built into this model. The other thing that we build into this model goes back to something that Paul said, and that is there's this nasty speed bump. There's actually, to financial outcome, there's actually 3 speed bumps. The first speed bump is transition. And it's at a very simplistic level. During transition, you will receive less per pound, per ton, per bushel from what you're growing, and your input costs will be higher, perhaps. That's one speed bump. The second speed bump is transition, but from a different angle. During transition, you're going to take some abused piece of land and shock it into an effective organic producing piece of land. I've seen 2 strategies. I've looked at a lot of farm numbers. While I'm not a grain person, I've looked at a lot of numbers on these farms. There's 2 strategies I see. Keep costs very low and try like heck to grow something that my neighbor will buy or somebody will buy, non-GMO stuff. Hay is a big or by hay I mean alfalfa in this dairy state. That's a transition strategy. That is a slow revitalization of the soil strategy and a low-cost strategy. I've seen exactly the opposite, where people don't even get an income from the land they're transitioning, but they spend money to rapidly change the soils. So I'm not going to make that decision for you. I'm not even going to recommend one over the other. That's up to you. But the model allows you to do that and see the financial outcome of either of those strategies during transition. So speed bump number 1 is transition. Speed bump number 2 is transition. Speed bump number 3 is the fact that you have to have, over time, a soil building rotational strategy. And that's a speed bump because in that strategy to build soil, you have to grow some crops sometime that don't make you very much money. And so Speed bump number 3 is rather unusual to many people who start out as conventional farmers. But it's necessary to transition land into an effective organic farm. And if you don't do it out of altruism, out of moral fortitude, NOP and your certifier will bite your heels and make you do it. There's a little rule in the NOP regs called 205.205 that says, I'm paraphrasing, you'll use a rotation to improve the quality of the soil. And any certifier that has any integrity whatsoever will make sure that you do that because it's part of the NOP rule. So that is the third speed bump. We've taken that into consideration in this model because we're looking at 10 years, 3 years of transition or less, or no transition. The model will accept either, and then 7 years of organic production. So we're looking at the cash flow, ultimately the cash flow. What is cash flow? I'll show you in detail until your eyes will roll up into your brain and you'll say, what the heck am I doing in this room? But in essence, it's this. There is an engine called operations that throws off cash, you hope. You use that cash for various things. If it doesn't throw off enough cash and you want to stay in farming, you put cash into it. That is a use of cash. So you have a source of cash and a use of cash. If you're transitioning from a conventional farming situation to an organic, you're probably buying iron that you don't have on hand right now. That is also a use of cash. So the machine that generates cash without you going to Compeer and borrowing it is profitability. The use are all these things you need to sustain that economically. And economic sustainability is built into this model because if you don't recognize that at a certain point you're going to have to replace iron with more iron, and you've got to have operating funds down the line, you are not economically sustainable. So we've built that into the model as well. So now we're going to talk how the model is organized. There are 6 or 7 tabs in this model. One is a user manual. And the user manual is about 6 or 7 8.5 by 11 sheets of paper that you can print off of the model if you want to have it over here to look at while you're using the model. It gives sort of the conceptual background of the model, and then it goes tab by tab by tab and instructs you what you have to do to populate these 5.5 determinants, knobs, on the money machine, on your farm. So we start with the user manual, as I've said, and I love working with the university because the university has people who are much better at these things than I am. I gave them the algorithms, the raw spreadsheets, and they've turned them into a very user-friendly tool with navigation buttons, et cetera, et cetera. Okay?
Just looking at
Yes.
what you just talked about.
Yeah.
Did you want to talk about the book that
Yes. So within these navigation devices, we're going to reach out to some data sources. And Jody reminded me, Paul is writing, it'll be available in March online, a tutorial that expands on these very brief comments he made, but expands rather dramatically on sources of information, how you use the information, and what it looks like. From the perspective, by the way, of the farmer and a lender. If the farmer does a good job of researching all this and can and has credibility in determining these 5.5 determinants, these knobs that run the machine, a lender has more confidence that the numbers coming out of this tool are meaningful. And so that's what Paul's tutorial, if you will have. There is a link from the is this his pointer?
Maybe.
Yeah, maybe. Yeah, it is. So this is a link, this guy right here.
Will be a link.
Will be a link is in about March to that tutorial.
A booklet.
A booklet. In addition, also in the user manual, and if you'll slide down a little bit, there'll be another button that'll come up at you. Or there. So there are also some links to other data sources. This is not an exhaustive list, but some that I find other producers have used to get data. There is beginning to be some benchmarking information from real farms. So this is not somebody just trying to sell you something. If you buy this thing, you'll get this yield. This is what farmers have actually done with organic yields and the prices they've actually seen. The University of Minnesota has something called FinBin. It is richly populated with conventional crops. They're beginning to populate it with a small number of organic producers that are giving information. Our friends at USDA AMS, Agricultural Marketing Systems, are beginning to capture the wholesale price of grains, meat, milk, eggs, etc., and vegetables, by the way, in databases that we are conventional people should be very familiar with, market reports. There's a link on here to those. So that's the sort of the concept here is in the user manual, give you a background, tell you how to populate each of the important sheets, the inputs to the machine, if you will, and reference a couple of data sources for things you don't control well. So you can reach out and see what other people have done. It's in ag economics, it's called benchmarking. So let's go to the first input page. That one.
Should we make it smaller?
Let's see. We could. Oh, I wish I could do this on this
I know on your
PC.
Mac.
I can do it on my Mac.
He's a Mac
No, I can
guy.
do it on a Mac.
I know you can do it on a Mac.
Okay, so starting with the knobs, we're going to populate. You've got to go do your homework. This is your tool. This is not a prescriptive tool. This is just a workbench for you to be able to turn the knobs and see what the outcomes will be. So the first knob is, what are you going to plant? I talked about that before. In the context of a rotation. And so we take a hunk of land, this is very awkward, I'm sorry. This is the crop planting page, and we have some preloaded. Everything in a darkened shade is preloaded. Everything without shade is an input cell. We start with the year that you are looking at.
So Jim, it's easiest if you use this little thing right here.
Oh,
so if you
yeah.
wanna point by just using the mouse pad.
Thank you, Karen. Can I leave you to your own devices?
I think so.
Okay.
People that are half my age are so much smarter. So you laugh. That's about right, half. So you start out with the first year that you're going to be looking at. Just a side comment here. There's an underlying assumption that you've got control of this land over the 10 years. And that may seem completely crazy to you that if you don't own land, that anybody would allow you to have it 10 years. I have worked with some owners who did exactly that because they wanted organic production on their farm and they trust organic farmers. And they made a 10-year contract with a farmer. And so it isn't crazy. If you own it, if you can lock down a long-term contract, we're in business here. So you start out with the first year you're going to be farming this chunk of land, and you put in your rotation. Well, first of all, in the oh yes, yeah.
We're not that fancy.
Yeah. So here we're talking about, in the upper Midwest, we just locked in corn and beans and a small grain and alfalfa. There's a market for alfalfa, so we locked it in. But then we allow a person to add small grains and other crops. So if another crop is edible beans, you can put that in there. If another crop is corn instead of wheat or oats, you can put that in as another grain. And then we ask the user, the program asks the user to, if for instance you put in, this is very dangerous for me, I'm showing my age. 2019.
Put in 1990.
Okay. Anyway, it'll populate the years out throughout the whole workbook. And that's how this thing is designed. Anything you put here as an input will populate the rest of the workbook. So you put that in that year, in 1919, joke. You put in, I have 20 acres of transitional corn. I have 40 acres of beans, etc. So you just populate this as you would any rotation. I won't put it in, it'll take too much time. But here is where you can start testing the proposition. Will I try to get an income during transition years, a big income? Will I try to make a medium income and build soil, or will I get no income and really put the foot on the pedal to build soil? You can come back in this tool over and over again, that's how it's designed, and change your assumptions and see what the results will be under changed assumptions. Make sense? Okay. Down here, okay, hey guy, move it down a little bit for me. There we go. Down here, we're going to ask you to, on those crops, make an assumption of yield. And I'll just give you a hint, if you're not already in the business, if you're just kicking the tires of this business, there's two excellent sources, the best sources that you can get. One are some of these benchmarking data sets that we're talking about at the University of Minnesota. I think you guys have some in OGRAIN, perhaps, I don't know. Talking to other producers, especially other producers in your area, because the soils and the climate are very similar. So you've got to come up with a yield estimate for all of the crops. But we've got a little twist here. We want a transition yield assumption, and we want to bracket the yield assumptions going forward into low, medium, and high, for lack of better words. You know, how bad could it get? How good could it get? And what is the average? Nature doesn't let us deal with averages. Markets don't let us deal with averages. So you need a band of possibilities here. Then assumption, if that hasn't tortured you enough, now you've got to make some assumptions on price. And I will say that on the crops that we love, which is corn and beans, we love corn and beans, there is now some reasonable data on what has happened in the past. And if you go to sessions like this and can get away from these Debbie Downers, these NFO Debbie Downer guys, and are not selling to your neighbor, You can talk to people who are in this market and get a heck of a lot smarter than you are on your own. This is huge. Price is huge, as we all know, in agriculture. And so this, if you're going to blow your brains out, this is the place to blow your brains out. So you put, again, during transition, how much am I going to get for GMO corn? How much am I going to get for non-organic alfalfa? Do I have a dairy producer, a CAFO dairy producer that would absolutely love to buy alfalfa off one of these fields, and oh, by the way, would love to bring their manure back on this? And now you're beginning to get at the next step, which is input costs. If you could make a deal like that, instead of just shipping off with every ton 15 pounds of nitrogen and 5 or 6 pounds of phosphorus and 15 to 20 pounds of potash, which is what you do with a ton of forage, you could be getting back from a partner like that, so to speak. Anyway, that's just a side idea. Then this sheet down on the bottom calculates for you yield per acre times price and gives you a dollars per acre revenue. On Schedule F, we call it income, but if you're smart about finances, you call it revenue. It's gross income, not net income. And that shows you now in this table, you can start beginning to see the financial impact of some of your decisions above. How much gross revenue am I going to get per acre based on those assumptions I made? Okay. And that will come out in terms of transition, low case, medium case, and high case. Next page, I think I can do this. Okay, this is where the work really starts. You've been off in Never Never Land making assumptions, but this is real work here. For every crop that you input on the first page, every crop designator, there is a crop input cost table on this sheet. And so corn was one that was cooked into the program, but anything you put there, edible beans, these other things, will pop up on this sheet as well. And there are some common categories of cost, which we all know. So these are some of the other sheets. Yeah, so zip back up to the top. So these are the input cost sheets. And the common ones that we know about are seed, crop seed, other seed, which might be a cover crop seed or a companion crop seed, fertility inputs, soil amendments, irrigation, crop insurance, other cash expenses that you have with respect to this crop. And then the really hard part, if you're not already in the business, is what machinery operation are you going to have to deal with to make this crop? This is the iron part. How much iron am I going to have to run over the field to make the crop grow? And rather than reinvent the wheel, we suggest right here that you go to Iowa State University, machinery cost calculator. It's a brilliant spreadsheet. And in that, you input stuff from your records. How much did this machine cost me? How many years am I going to have it? What might it be worth when I get rid of it? What is my diesel cost? What is the labor of the person that's going to run this machine? If it's me, should I put some number in there? Yes, you should, unless you want to work for nothing. If you want to work for nothing, the results will be you'll get nothing. So it's important to put some modicum of value for your own time in this thing. And what it calculates for you down here is ownership costs don't pay attention to that for this use, because we have another way of capturing it. But right here, it's the stuff that might cost you money right out of your checkbook. It's repair cost on a total and per acre basis. That's the reason I really like this spreadsheet. Fuel and lubricant and the labor cost based on what you put in at your rate, or if you have to hire some kid, probably not a kid with this stuff, but somebody big enough to make the stuff go. Take those numbers and populate the OGRAIN spreadsheet with those numbers based on what you think you need to do in this field to make the crop grow. Okay?
Back to this one.
Yep.
Oops.
Incidentally, this is a link, and if you have the right internet connection, this will take you, this little link right here. John Hendrickson designed this. That link right there will take you to that spreadsheet. If it doesn't, just download it and have it handy. Okay? So there's one or two anomalies that we should talk about here. There may be crops where you want to take, and you may have a soil nutrition setup where you can take crop residue off the field. If you've got your phosphorus buildup high enough on corn, if you take corn stalks off, you're going to take phosphorus off. But if you're good enough, if your soil's good enough, you don't need that phosphorus back in. And in fact, in some places in Wisconsin, you may want to get rid of the phosphorus. So you sell corn stalks. And you have to realize that under the organic rule, anybody in my business has to buy organic bedding. And so organic bedding, year in, year out, is more valuable on the market than is conventional bedding. And so there is a possibility to make money on this if you don't need that residue to go back in to provide the next crop with the NPK and all the traces that are contained there. Okay, so that's this, straw and stalks. Yes, ma'am.
Are we limited to the amount of other crops? Or just, I think there's 4.
I think there's 4 or 5. John and I struggled with how many to put in there. If there's, I'm glad you asked this question. Here's how we've done all these compass tools. These reside at the university. And these are not rocket science. This is just taking basic ag econ and putting it in a handy form. If we have users that want us to put in, now, I won't let you put arugula or lettuce or tomatoes in here. but if enough users of this say it is restrictive to have only 4 different crops, you get a hold of John, and there's contact information here, and John and I will rejigger the tool and make it more usable. We've done this with a compass for vegetable farmers over a 15-year period. It has become much richer because users have said, I need this, 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 and this. And we plan to do that with this tool. So.
For example, you could have a no-till soybean and then a till soybean.
Exactly. That's right. Yep. Absolutely. Did you hear what she said? You could, even within a specific species, like soybeans, you could have no-till soybeans and cultivated soybeans. And in Wisconsin, with our variable topography, that is very possible. If you don't get erosion on a flat field, you could bare cultivate it. In a more sloping field, you might want to go no-till. In fact, as a soil conservation nutcase, I would suggest you do that. Okay, so within the program, we allow you to recognize crop residues. Okay. So the next page, you can take a rest because it is only an output page. So we've taken all the stuff that you've given on the handles that you've turned on the first 2 or 3 pages, and now we calculate in the tool the per acre revenue, per acre cash expense, and per acre gross profit. Gross profit, if you're not familiar with the term, is revenue less production cost. And so this is the gross profit. This is the contribution of that crop to the cash flow that we're going to calculate later. So we need this page in the tool, but this page, the reason we put it here is it is informative to you to see on a per acre basis the variability of profit across your rotation. Okay? Now this is an age issue. I'm getting a little.
You getting shaky up there?
Yeah. No, always. Not up here. Always. Okay, so grain production, you know, I can raise a heck of a lot of beef with a 50 horsepower tractor, a manure spreader, a brush hog, and a bobcat. This production takes iron. And either you own the iron, you lease the iron, or you rent somebody else's iron and them as an operator. We have assumed that if you rent iron, it will be a cash expense on that cash input for each crop because you're writing a check for it. If you own the iron, we have to take it into account because number one, it is cash being used, and number two, you're going to have to replace that piece of iron at some future point. And so this sheet looks at every piece of iron that you had at the get-go, items on hand at the beginning of the period. A side note, if you have already entered into organic production and you're just looking at adding another 50 acres, pursuant to what Paul said about chip away at it slowly, you should prorate these items versus how many acres of organic you have and how many acres of conventional you still have. So if you have you grain guys might spend $100,000 on something. If you're 50-50 on acres of conventional and organic, take 50% of the value. So you list the item, you list its current value, right here, the year that you plan to sell it, if you're going to sell it within the 10 years, and what value you might get when you sell it. That's what you have on hand. If you list out here, if you list a year of selling here that is within the 10-year envelope, this program will automatically depreciate up to that point and then throw it out of the rack-up of the stable of equipment that you have. So the input pages here, or the input cells, are the white cells. Down here, this doesn't work like my Mac. How do you move this thing around here? Down here, yeah, are plans for disposal or acquisition of equipment. Subtitle, however, is equipment to be purchased. This is new stuff that you need to get. And so you put in the description of that toy, its expected price, and the date that you're going to purchase it. And this table then populates out in these cells the fact that you acquired that piece of equipment on a certain date. Okay? And it also records the fact that that is a cash use in that year, which leads into the cash flow statement that we generate at the end of the tool.
Can I ask a question?
Yeah.
What happens as your acreage use increases? How do you accommodate that in the upper part of the tool?
Okay. The question was, if you are constantly increasing the amount of acres that you're using, This tool is a forward-looking projection of making a decision. The decision is, I'm going to add acres. Okay? The fact that you added acres in the past is a sunk cost, a sunk decision. So if you're looking forward, you're going to use that something you had on hand, you're going to use it going forward, and you do what I said before, and that is that let's say that you've been farming 200 acres, you're going to add 50, you take 5 over 200 times the amount of that asset and ascribe it to the new endeavor. That makes sense? Maybe. We can help you through that.
We have about 10 more minutes.
Okay.
Make sure we're-
Yep, we're on track. So now we introduce a new item, a new concept on this page, and that is a capital asset recovery rate. And what this is a rate, Paul informed us how he looks at farmers' financials. And the way he looks at it is he looks at the assets they have employed, and he asks himself, as a lender, is this farmer getting enough profitability that when that piece of iron fails, he can replace it? And the easiest way for him as a lender to do that is to ascribe a capital recovery rate to that piece of, to that asset. And that's what this CAR is. In his practice, he uses about 12% for equipment. Now, 12% assumes that you're going to keep something about 8 years, because 1/8 is 12.125 or 12.5% of that asset. If you, in your heart of hearts, say to yourself, I'm going to keep this thing a long time. After all, farm machinery wears out not by the year, but by the hour. And if you're not going to heavily use this, you could convince yourself you're going to keep it a while. This is your sheet, not our sheet, not his sheet. You could put a lower rate in there or a higher rate if you're going to turn it over quick, if you're using more hours per year. If you go back to that Iowa State University machinery cost sheet, you can play with these things to determine the real numbers on one piece of equipment. Okay? Similarly, in your grain operation, there may be buildings and infrastructure. A building is for a grain operation would be what? A grain bin, a dryer, machine shed. Very good. I forgot about those machine sheds. My stuff sits out. A machine shed. It could be an irrigation system that you drill a well. That's a fixed asset. So that's infrastructure and buildings. These are handled exactly the same way that equipment is handled. You just list what you have now. Will you ever get rid of it? And the only thing I can think in that category that you could get rid of, you could sell a grain bin to upgrade to a bigger grain bin. So you list it as a sale above of stuff that you have coming in, and list a new grain bin as a purchase down below, which is down here. Oop. How did I do that? Down here, listed as a purchase. It does exactly the same computations that the equipment page did, but these assets, even if you look at IRS regulations, but in fact, they last longer than iron and steel. And so the capital recovery rate that you would put in lower on this sheet is a smaller number. A 5% capital recovery rate assumes a 20-year lifespan on a building, which is about what you can get by with IRS. And then finally, there's another very important input that you have to do on the final rack-up of all of the work you've done before. And that is, remember, we bracketed the yields and we bracketed the cost or the price. And the assumption was that that was it was transition, low case, medium case, high case. How do you slide this thing around? But I want to go out.
It's this white guy.
Okay. So out here, out at the, let me point to it. Oh boy, how did I do that?
Do that, you made it go far, far away.
Okay. This little guy right up here is a scenario key. Transition is 1, low case is 2, base case is 3, and high case is 4. You put those scenarios in. Let's see, now I'm getting smart. This guy, right?
You have to take that whole bar. There you go.
So, in the white blocks at the top of this table, these right here, this is transition year, so you'd put in a 1. In that year, if you had some organic production, let's say that when you bought this land or got this land, you had a PLUD, a PLUD, a prior land use declaration by whoever sold you the land, and it had been in CRP. So you could have organic right off the get-go. You could therefore put in that first year that it was organic. But organic, remember, we had this envelope of possible inputs and outputs. So, being a smart operator, what you would say is, if I just converted this from CRP, I'm not going to get a good yield. And so you put in a low yield scenario. That's, according to what I just showed you, a 1. So you'd actually just put that in that block right there and go out for the whole 10 years and use your best estimate to do what very sophisticated programs call a Monte Carlo, or what's the possible thing that could happen going forward. So you can't put in all high yield years. That isn't going to happen. You can't put in all low years unless you have assumed that you are totally inept at this, which I hope you wouldn't. So you put in a mix. I'm going to have some high years. Mother Nature's going to whack me. I'm going to put in some good years, and I'll put in some base years. You put that out all the way out to the 10 years, and that will reach back in the program and pick the relevant income and cost numbers from the earlier part of the program. Okay, this little guy, I would presume. Now, there are a number of costs that, regardless of whether you get a yield or don't get a yield, or plant something or don't plant something, you're going to have that cost. These are important to include and do your best efforts of estimating these things, because they are real costs. You write real checks for these things. And there are things like, and you can change these categories if you see the world differently than we have seen it. Organic certification. Organic certification has 2 pieces, as we all know. One is yearly certification cost, and the other is a percentage of the total dollars that you are selling organic. And so you could make an estimate of this. Eventually we're going to build the variable part into the tool, but it's complex enough as it stands. Farm insurance, put it across the whole farm, across the whole years. Utilities, dues and professional fees, you get the point. These are, quote, overhead items on a farm. So they go in these white boxes, and then everything you've put in before populates the colored parts of these pages. And what will happen is that on the top of this final box, you will have the cash that you have generated by your profit machine. Whether it's positive or negative depends on the assumptions that you put into it. But you can't run negative every year, year in, year out, so you've got to go get some funds someplace to balance it. So in the using of this, you'll come down to this line of net cash flow of both, yeah, a little bit up. So cash flow that you got out of the profit machine, how you might have used some of that cash outside of the profit machine, will end up with how much cash do I have in my bank account at the end of the year. Now, there is a little anomaly that we put into this program on purpose to make it simple. We do not account for the fact that at the end of a particular year, you might have produced grain, but you have it in storage. We've said that over a 10-year period, you're not going to have something in storage for 10 years. It's going to flush through the system. And so it's going to become a cash receipt at some point. If you're looking at year by year by year, you have to take into account that inventory carryover. So you're going to find out if you've got money at the end of the year. If you don't, you got to go get it someplace. So you go to Paul with all these numbers and clean clothes and so forth and so on, get some, please. And that's, yeah. And so this is the bottom of this. If I didn't generate enough cash, where am I going to go get it? So with this cash flow, Paul, with his app, could generate for you the internal rate of return for this endeavor that you're entering into. So that's the tool. Download it, play around with it. I encourage you, go through it once, and if the results are not to your liking, or if you think you can do better, go back and make different assumptions as long as they're realistic.